Gold just suffered its biggest single-day crash in over 40 years. Silver plummeted more than 30% in a move that traders are calling a capitulation event. And Bitcoin, well, the so-called digital gold shed nearly 10% of its value in a matter of days, dragging the entire crypto market down with it. The charts look like a crime scene, but the weapon wasn't a recession, and it wasn't a new war. It was a name. Specifically, the name of the man President Trump has just nominated to replace Jerome Powell as the next chairman of the Federal Reserve, Kevin Warsh. To some, he's a Bitcoin-friendly pragmatist who once told Stanley Druckenmiller that crypto was the quote, newest, coolest software. To others, he's a monetary hawk who wants to drain liquidity from the system so aggressively that it could send risk assets back to the Stone Age. The markets are panicking because they don't know which Kevin is going to show up in May. Is he the savior who will legitimize Bitcoin, or is he the saboteur who is about to pull the rug on the liquidity cycle? My name is Lewis, and you're watching the Coin Bureau. Now, before we begin, I'm not a financial advisor, and nothing in this video is financial advice. It is educational content intended to help you navigate the treacherous waters of central bank policy. If that sounds useful, well, smash that like button and let's get into it. First things first though, who exactly is Kevin Warsh? Because if you look at his resume, it reads like a script for a Wall Street thriller. Warsh isn't your typical academic economist like Janet Yellen or Ben Bernanke. He is a creature of the markets. He started his career in the trenches of Morgan Stanley's Mergers and Acquisitions department before heading to Washington to serve as an economic advisor to George W. Bush. Then, in 2006, at the tender age of 35, Warsh became the youngest Federal Reserve governor in history. He was thrown into the fire almost immediately. Warsh served from 2006 to 2011, meaning he was in the room where it happened during the 2008 global financial crisis. He was the Fed's liaison to Wall Street, the guy Ben Bernanke sent to talk to the banks when the world was ending. Since leaving the Fed, he hasn't been sitting idle. He's a fellow at the Hoover Institution, a lecturer at Stanford, and perhaps most importantly, he's been working closely with billionaire investor Stanley Druckenmiller. Now, this connection to Druckenmiller is crucial. Druck is a legend who famously worked with George Soros to break the Bank of England back in 1992. And he has been a vocal critic of the Fed's easy monetary policies. The fact that Warsh is his protege tells you a lot about his worldview. It suggests a philosophy that values market discipline over endless money printing. And this brings us to the big question. What does Kevin Warsh actually think about crypto? Because if you dig through the archives, you will find quotes that sound incredibly bullish. In a 2015 conversation with Druckenmiller, Warsh famously called Bitcoin, quote, the newest, coolest software, and suggests that it could serve as a market discipline for policymakers. He didn't dismiss it as rat poison. He didn't call it a scam. He recognized the technology. More recently, in a 2021 interview on CNBC, Warsh dropped a line that had crypto Twitter cheering. He said, and I quote, if you're under 40, Bitcoin is your new gold. He acknowledged that for a younger generation, digital assets have replaced precious metals as the preferred store of value. Just last year, in May 2025, he stated plainly, quote, Bitcoin does not make me nervous. He even went as far as to say that it could function as a, quote, sustainable store of value like gold. So, case closed, right? We have a pro-Bitcoin Fed chair incoming. Moon mission confirmed. Well, not so fast. Because while Warsh respects the technology, he doesn't necessarily view it as money. In a 2022 Wall Street Journal essay, he wrote that crypto is, quote, software, not money. And he dismissed many private crypto projects as fraudulent. His stance is one of nuanced pragmatism, not evangelical support. He sees Bitcoin as an asset, yes, but he also sees it as a symptom of speculative excess caused by easy money. And that is where the problem lies. You see, Kevin Warsh has a track record, and that record suggests he is a hawk in dove's clothing. So let's go back to 2008. The housing market was collapsing. Lehman Brothers was teetering. Unemployment was skyrocketing towards 10%. Most Fed officials were terrified of deflation and a depression. But not Kevin Warsh. If you read the transcripts from those Fed meetings, and believe me, they make for some sobering reading, Warsh was consistently the voice in the room that was warning about inflation. In June 2008, he told his colleagues, quote, "Inflation risks, in my view, continue to predominate as the greater risk to the economy." In September 2008, the very month Lehman collapsed, he said, "I'm still not ready to relinquish my concerns on the inflation front." Even as the economy burned, Warsh was worried that the fire hose wasn't water, but really gasoline. He eventually resigned from the Fed in 2011, largely because he disagreed with the Fed's second round of quantitative easing, or QE2. Now, why does this matter for 2026? Well, because Warsh has been consistent. He hates quantitative easing. He has called the Fed's balance sheet bloated. Currently, the Fed's balance sheet sits around $6.6 trillion. It has come down from its peak of $9 trillion, but Warsh believes it is still far too high. He wants to shrink it, and in central banking terms, shrinking the balance sheet is known as quantitative tightening, or QT. QT is the opposite of money printing. It is the withdrawal of liquidity from the financial system. And if there is one thing that crypto needs to survive and thrive, well, it's liquidity. When the Fed buys assets, numbers go up. When the Fed sells asset, well, number go down. It's that simple. If Warsh follows through on his instincts to aggressively shrink the balance sheet, well, he could inadvertently crush risk assets, including Bitcoin, even if he likes the technology. Now, this prospect of a liquidity drain is terrifying for anyone holding risk assets. But do you know what's even scarier? Well, losing your hard-earned crypto to high fees or bad execution because you're using the wrong exchange. And that is why you need to make sure that you're getting the best deal possible. And we have spent years vetting the top platforms in the industry to find the ones that actually treat retail investors right. We're talking about exclusive sign-up bonuses worth up to $100,000, trading fee discounts of up to 50%, and deposit cashbacks. And these are offers you cannot find just by going to the homepage. You have to use our link. So stop paying full price fees to trade your own money. Protect your capital so you can survive whatever volatility Warsh brings to the table. Hit the link in the description or scan the QR code on the screen right now. It helps support the channel and it keeps you in the game. Now, back to the nightmare scenario. Because there is a massive contradiction at the heart of this nomination. President Trump didn't nominate Warsh because he wants tighter money. Quite the opposite. Trump has been vocal about wanting interest rates slashed. He has demanded rates be, quote, 2 points and even 3 points lower to goose growth and lower debt costs. So, we have a president who wants aggressive easing and a nominee who has spent his entire career warning against the dangers of easy money. This is the pivot. Will Warsh bow to Trump's demands or will he stick to his principles? Analysts are split. Some, like the team at Renaissance Macro Research, argue that Warsh's recent dovish comments, where he suggested productivity gains from AI could allow for lower rates, are just a convenient shift to get the job. They think that once he's in the chair, the hawk will return. Others point to the Nixon-Burns parallel. In the 1970s, President Nixon pressured Fed Chair Arthur Burns to keep rates low to help his re-election. Burns caved. The result was the Great Inflation of the 1970s, a decade of economic misery that didn't end until Paul Volcker jacked rates up to 20%. Warsh knows this history and indeed has written about it. The question is, can he resist the pressure? If he tries to compromise, perhaps by cutting rates to please Trump, but aggressively shrinking the balance sheet to satisfy his own hawkish conscience, well, we could end up in a very strange environment. Imagine a world where interest rates are low, but liquidity is scarce. That is a recipe for volatility, and the markets are already pricing it in. And let's talk about that market reaction, because the numbers are truly mind-boggling. When the news broke on January 30th, gold didn't just dip, it crashed. We saw the yellow stuff plunge from record highs near 5,600 an ounce to below 4,900. That's a drop of roughly 12% in a single session, the biggest one-day decline since the early 1980s. Silver fared even worse. It plummeted 31.4%, wiping out months of gains in hours. It was the worst day for silver since 1980. And Bitcoin, well, it dropped from around $90,400 to the low 80,000s. Why? Why would hard assets crash on the news of a Fed chair? Well, the answer lies in what Wall Street calls the debasement trade. For the last year, investors have been piling into gold, silver, and Bitcoin because they believed the US government had no choice but to print infinite amounts of money to pay off its debts. And they were betting on the debasement of the dollar. Warsh represents a threat to that trade. He represents discipline. He represents the idea that maybe, just maybe, the Fed won't monetize the debt. When Warsh was announced, the dollar rallied and Treasury yields rose. The market essentially said, oh no, the adult is back in the room, and he's going to take away the candy. If Warsh successfully restores credibility to the dollar, well, the argument for holding gold and Bitcoin as a hedge against currency collapse gets weaker in the short term. That's why we saw that violent unwind. But here's where things get interesting. Is this reaction rational? Most experts don't think Warsh can actually stop the printing press forever. The US debt load is simply too high, but in the short term, his nomination signals a regime change. So, what does this mean for 2026? Well, the Fed currently projects just one rate cut in 2026 and one in 2027. That is a far cry from the 2 to 3% slash that Trump wants. If Warsh takes the helm in May, we are looking at a volatile mix. In the short term, we might see a relief rally if he talks dovish to get confirmed by the Senate. But structurally, if he follows through on his philosophy, we are looking at a higher for longer environment for real rates, combined with a shrinking balance sheet. For crypto, this is a double-edged sword. Warsh understands the tech. He won't try to ban it. He might even try to push for clearer regulations that legitimize the industry. But he's not going to pump your bags with easy money. He views Bitcoin as a policeman for fiscal irresponsibility. If Bitcoin pumps, Warsh takes it as a signal that he needs to tighten policy. It's a self-correcting mechanism. This suggests that the parabolic, up-only liquidity-fueled rallies of the past, well, they might be harder to come by under Warsh's Fed. Instead, we might see a market that trades more on fundamentals and utility and less on pure monetary debasement. And there is one final wrinkle. Well, that's the Senate. Warsh isn't confirmed yet. Senator Thom Tillis has threatened to block all Fed nominees. If Warsh gets stuck in confirmation purgatory, we could see months of uncertainty. And as we all know, markets hate uncertainty more than anything else. So, where does this leave us? Well, the nomination of Kevin Warsh is a game changer. It signals that the era of the Fed put, the idea that the central banks will always step in to save the markets, might be coming to an end. Warsh brings Wall Street credibility, but he also brings a hawkish ideology that hasn't been tested in a debt-laden economy like the one that we have today. Whether he is a savior or a saboteur depends entirely on which version of him walks through the doors in May. Will it be the Trump loyalist calling for rate cuts, or the inflation fighter crushing the balance sheet? And remember this, Warsh may soon be sitting in a big chair at the Fed, but it won't be him alone making the decisions on interest rates. The Federal Open Market Committee, or FOMC, is a body of 12 Fed officials, including the chair, who collectively make their calls at regular meetings throughout the year. Warsh could bang the drum for rate cuts all he likes in theory, but if he can't get the majority of the committee to go along with him, then Trump may not get his wish. For now, though, the debasement trade is unwinding, and volatility is the only guarantee. If you are holding crypto, you need to be prepared for a bumpy ride. The long-term thesis for Bitcoin remains intact, okay? Warsh can't fix the national debt overnight, but the path there just got a lot more complicated. Now, I want to know what you think. Is Kevin Warsh good for Bitcoin because he understands it? Or is his hawkish policy going to crash the markets? And did you buy the dip on gold and silver? Or do you think that there's more pain to come? Let me know in the comments below. And if you want to understand more about why the global liquidity cycle is the only chart that really matters for crypto, well, you can check that video out right over here. Thank you all so much for watching, and I'll see you again very soon. This is Lewis, over and out.